Well, good morning, everyone. Today is Tuesday. It's January 14th, and we have the Consumers Price Index data coming out in about 12 minutes. Again, Fed data has been extremely predictable, extremely mild, and extremely on point. If the number is anywhere between 0.1 and 0.3, I'm not expecting a major difference. Honestly, it would take something really strange to happen for the number to be really far off. So anything that's showing us that there's mild, even stagnation, but not a downside in the CPI would be sustainable and it would be acceptable. So I'm not really seeing anything major there. It's coming out in about 12 minutes, and I don't think that number is going to have a major impact on the economy. But as we get ahead in the week, we've got the PPI number and we got retail sales. Now, typically jobless claim is the big number on Thursday. And Friday we have employment data, but we don't have it this week. But this week is going to be different. The reason is the Fed is running out of ammunition. That's why Fed data is becoming less and less important, but economic data is becoming more and more important. You see, whether jobless claims are good or bad, the Fed is putting themselves in a corner because they've lowered rates 3 times last year. And the last 2 times they've done it, the long bond, the 10, 20, 30-year bond, has not responded. As a matter of fact, as of right now, the long bond has topped out, okay? Has topped out. As a matter of fact, I'll show you an example so you'll see what I'm talking about. And this is why Fed data is not nearly as important as it was a few years back. The Fed is extremely expressive and telling us exactly what they're thinking. So, first time the Fed lowered rates, let me make this more palatable for you. First time Fed lowered rates, market went up. Second time Fed lowered rates, we went up, but we couldn't break out the high. Fed rates going lower, bonds going lower too. Remember, bonds and rates are inverse. So what we should have seen is a rally up to here, but we didn't. Fed did it again. We only went up here. Down slope. This is a descending triangle. So as far as I'm concerned, see that? I'm expecting a break to the downside. Fed rates have been going up since September, all right? So the Fed could lower rates all they want. Mortgage rates, long-term rates, they're not going lower. If you guys have a mortgage, you should know that. Interest rates have not gone lower. They've gone higher. You can see it right here. The Fed said enough. The bond said enough, Fed. We're going to go higher. So that's happening right now. So I'm not seeing the economic data as far as jobless claims or employment data being a major catalyst. What I am seeing as being a major catalyst is the retail sale and industrial production. These two reports are going to give us a better and not a better look at the economy, a look at the economy from a different perspective than jobless claims or employment data. So these are the two major reports this week. PPI is going to be fairly important, but honestly, remember, retail sales makes up 70 to 80% of the GDP. And the GDP, the growth domestic product, is what the Fed uses to determine if economy is growing or not. So retail sales and industrial production are going to be very important. Till that time, not expecting a lot of volatility in the market. More fundamental data, this is very positive, and this is going to start making me focus on the financial sector because it's doing very, very well. Fourth quarter profits for JP Morgan jumped 21%, much better than expected, mostly due to more institutional trading. It's right here. That's very, very important. Why? Well, look where the financial sector is. It's already in the top 2 spot, and I think it's going to lead over. Now, financials are typically slightly defensive. All right. So technology being in the number 1 spot and financials don't look to make a lot of sense. And with consumer discretionary being in 8th place and technology being in 1st place, remember these two are literally like M&M. They should be next to each other. Apple, Amazon, are they technology or are they consumer discretionary? You see the point I'm making? So technology and consumer discretionary should be next to each other, and they're not, which keeps telling me more fragmentation. So I'm looking at the financial sector to move higher or stay up here, and technology to move lower especially in light of what I'm about to show you. Two things. This is the S&P 500. We've been focusing on the NASDAQ 100 and the momentum levels, and I've been trying to explain to anybody who's been willing to listen to me that the markets are not overstretched like this. They're overstretched like this. It's like, ugh. And that's on the NASDAQ 100. But remember, those NASDAQ 100 stocks are also part of the S&P 500. And they happen to be the largest 100 stocks there. So this is having an impact on the S&P 500. If you don't pay attention to anything I say, that's fine. I won't take it personally. Maybe I will just a little. Just kidding. Pay attention to this. This is 5 years worth of data. This isn't 5 minutes, 5 days, 5 months. This is 5 years. It's a substantial period of our economy. Notice what happens every time the percentage of stocks in the S&P trading above the 200-day moving average. This is the fundamental moving average that tells us if stocks are bullish or bearish. Well, we're a little too bullish. Look at what happened. First of all, how many times did we go above 80th percentile in the last 5 years? Let's see. 1 time, 2 times, and 3 times. Look what happened the first time we poked our head above 80th percentile. We dropped to 50th percentile. That puts the S&P at the 200-day moving average. South of where we're at right now. Look at what happened here. We poked our nose above the 80th percentile again, and look at what happened. 50% of stocks in the S&P trading above the 200-day moving average. And here we are, we're doing it again. Now, to give you some perspective, if what I'm saying will materialize, and it will, let me just show you so you could look at it at the same, so we can be both looking at the same thing. This is the S&P 500. We're roughly at the 328 level, and if what I'm expecting to happen, what happened here, and what happened here, and it's going to happen. This is when markets are stretched to the extreme. So if this takes the market down to here, if this line moves back down to here, just like it did here, just like it did here, just like it did when it almost came up here, and dozens of other times over the last 20 years, this is just 5 years, we can expect the S&P to come down to the 300 level. That's not an expectation. That's almost a guarantee at this point. Now, obviously, I can't guarantee anything because I can't predict the market, but 5 years of data, 10 years of data, if you look at 10 years of data, you'll see same thing. Once we go above 80th percentile, we move south. 80th percentile, we move south. 80th percentile, we move south. It happens every time. Happened here, and it's happening right now. Don't say I didn't tell you so. Now, momentum levels, this is the percentage of this is a put to call ratio, number of puts versus calls trading. When we get down to 76, 70, it's telling us that too many call buyers are in the market. And usually when that happens, when markets gets too bullish, it switches and market turns to bears. And right now, 0.76, yesterday we were at 65. This is getting to nosebleed levels. And that's telling me that we're going to turn south. Again, I'm not expecting a bear market. I'm not expecting anything crazy to happen. I'm just expecting a nice cool off, taking the market to the 50-day average. The large caps. Now, small caps, tiny stocks, whole different world. Remember, they've been sitting on the sidelines. They've been sitting on the sidelines for the majority of 2019, waiting for this trade war resolution. Trump is going to be signing phase 1 completion. And that's amazing. And because of that, and I've mentioned several times, and again, as I showed you in this analysis, stocks are stretched out. Large caps are stretched out. Small caps, medium caps, just getting ready to move. Remember, small stocks are more speculative. They tend to move on better data, so ahead of data. So right now, small caps are looking forward and seeing this resolution of this trade war being resolved. We're supposed to sign phase 1 today and move into phase 2. So that's going to give you opportunities to trade in other type of stocks and make money while the large caps are kind of sitting and moving sideways. And so this is not the time to focus on large caps for all the reasons I just showed you right now. There's a solution. That's why I made the Cyborg Symposium available again. Now, this strategy will give you the potential in this type of market environment to make over, actually to double your entire portfolio over the next 12 months. Between 12 and 15 months, that's the goal. I'm looking to double the small caps because I'm looking for big rallies out of small stocks. Small stocks have been just sitting and waiting and waiting and waiting. They're not waiting anymore. Let me show you something cool. This is the Russell 2000. Check this out. Look at this. Look at this congestion. Look at this. Let me show you this. Look at this congestion. If this is not a congestion of all congestions, I don't know what is. Remember, the longer something stays in a congested period, the better the odds that the following breakout will be very strong. The small caps and medium caps, they've been sitting on the sidelines and they've been waiting and just waiting for this phase war, for this China and US to stop doing this and come to terms. And we are here. Large caps are due to come down. Small caps are rising. They're rising. They are completely outperforming larger stocks. And the smaller the stock, the better we're seeing it right now. Look at the tiny caps. Let me show you this. This is the smaller stocks, micro caps. Look at the micro caps. Look at this. Look at this congestion we've been seeing. This is what I'm seeing, a nice breakout. So sign up below, check out, get on this plan. You gotta get into the Cyborg. The Cyborg is the coolest strategies. It's designed to take advantage of the market in the current environment we are in. It doesn't trade large caps. It looks for smaller stocks. You don't have to worry about options, any of that stuff. Check it out now. Learn how to double your money over the next 12, maybe 15 months. I'm not exactly sure, but hey, it's a lot better than the S&P will give you over the next year, I promise. Check it out right now. Follow the link below. Get all the details while you still can. The Cyborg Symposium is made for a time like this. I specifically was sitting on this strategy and I wanted to release it right when US and China are going to start figuring out their differences, and we're seeing it right now, and this is the time to cash in. Follow the link below. Check out Cyborg. Watch the symposium. Follow the link below before it's offline. This is your opportunity to start 2020 on the right track, on the right foot. Do it now. Talk to you guys soon.